Good morning, ladies and gentlemen. Welcome to the second edition of Finance Hub with Dr. Joseph Eyakimwa. By introduction, I am an investment banker, a chartered accountant, a finance professional, an energy economist with about 20 years experience in the finance industry. We are looking at how to raise capital for business expansion. You know, in the first edition, we talked about start-up business. So to the glory of God, you started your business, things move according to plan, and now there is a more demand for that same business. But the capital you raised initially is not insufficient. How do you raise capital for expanding your business? So what is business expansion? Business expansion is a process of growing your business strategically from a smaller business to a greater business. So it is the growth aspect of your business. Like we said, the money you raised for the startup capital definitely will not be sufficient for you to take the business to the next level, because you might need to acquire bigger assets, you might need to acquire bigger premises, you might need to hire more staff, you might need to open a new branch, you might need to buy a new technology or even new franchises. So this aspect of your business is called the growth aspect of business. So it needs additional capital, because if you have this opportunity and you don't have capital to take the advantage, it automatically leads to loss of profit or loss of revenue. So you must know the strategies when you get to this stage, at this phase of my business. How do I take the business forward? How do I go further? How do I move into new geographies? So that is the purpose of the business expansion series we are going to look at this hour. So expansion capital is financing provided to mature or semi-mature businesses. Like I said in my intro, your business is not going mature. More people know about the business. Take for instance, maybe you started as a small production company serving a fewer market. Because of quality and maybe customer service excellence, more people now know your products. So instead of having maybe 100,000 orders, you're now having a 500,000 orders, a 1 million orders, a 10 million orders. So definitely the facility that was providing the initial 100,000 orders will not be sufficient to meet the expanded demand. So you need to raise capital so that you need to meet up this demand. Because if you don't do that, you are going to lose opportunity, you are going to lose profit, you are going to lose revenue. So what is the rationale for expansion capital? You must be able to maximize the opportunities that are coming. Because if you don't maximize the opportunities, your competitors are going to snap the opportunity, or a new entrant will come to fill that gap. What are the sources of this expansion capital? Like we said initially, when you started, you use your owner's equity, you even talk to family and friends, and now that is no longer sufficient. Maybe you even had few partnerships, people that brought money, you did profit sharing. But now, in expansion capital, you are now moving from short-term financing to long-term financing or medium-term financing. So you need money that will stay. So not just money that if I give you now, in the next 30 days, in the next 60 days, I will need my money back. No, sir. Because you are going to invest in long-term assets. You are going to invest in expansion. So you might even opt for a private placement of shares. So what is private placement of shares? So you are going to invite other investors to join your company. Now you now have a company. So you want to see, because in the last 5 years, in the last 3 years, this is what we have done. And your product is in the market. People know about your product. People have come to know you because of this service or product you've actually provided in the past few years. You can now say, instead of just being a customer, please can you be a part owner of our company? We're going to give you shares. Come and invest in our company. Those are equity shares. And equity shares can also be referred to as patient capital. So when people come in as equity investors, after you would have done your valuation, we'll talk about valuation in one of our series. After you have done your valuation and you say people come to buy into your business, they're not going to buy into the business today and take the money tomorrow. No, they're going to wait for profit. and then dividend. When you make profit at the end of the period, the company is going to declare dividend and then pay them the dividend at the end of the period. So you are not going to be on pressure, just like if you have taken loan from any of the financial institutions to actually finance your expansion. So apart from that, there's also what we call retained earnings. When business make money, they distribute some as profit, they bring some back into the business for expansion purposes. So take for instance, if you make an X amount, you say, okay, out of this profit of, let's say, a 10 million, a 100 million, a 1 billion, whatever, we are going to retain maybe 40% as our reserve of retained earnings while we distribute the others. So over the years, that retained earnings can accumulate. And when it accumulates, it becomes the first point of call when you want to do expansion. Can our retained earnings actually take care of our expansion? If yes, fine and good, you already have money saved for that expansion. But if not, then you can either do the private placement of shares, like we said, which is also part of the equity capital. So what you have done is because you have grown reputation in your business, you have been consistent within the period you started this business. People have come to know you. People have come to know your product. People want to take a bet on you. So with that, they can give you their equity capital for that. Another way again to fund your expansion is that you can actually reallocate your assets. I remember we used to have a client so many years ago that was actually looking for expansion capital. It is a manufacturing company, but they have so much land asset in the company. I would say, why are you looking for money while you have this premises, a lot of vast land doing nothing? So instead of you to go and look for money outside, this land is carried in your books, in your balance sheet as land, but it's actually not generating income. Can you actually reduce the size of this land, since you don't need this amount of land, and realize that land so that you can get cash to expand the business? And that was what they did exactly. So we call that either balance sheet restructuring or assets reallocation. So you might be having assets that I'm almost doing nothing. So you can allocate those assets to raise cash for business expansion. Sometimes again, you can also do what we call lease or buy. So you might have some equipment that you bought, they are free owned in your company, maybe heavy equipment that costs so much money, but you use them once in a while to execute your business. But the question now is that, can I actually sell this equipment to free up cash? Then anytime I need to use equipment of this nature, I lease. Maybe the leasing, maybe the job is for maybe 6 months or 3 months. So for that 3 months, you pay for the lease, use the equipment, and then you free it back, but you have free cash for the expansion. So that can also work. Then when we talk of debt financing for expansion, yes, you can also look at, if you are a publicly quoted company, we'll come to that later, you can raise bonds from the capital market. They are long-term debt financing. But when you are doing expansion, it's not advisable to use the short-term financing of banks for your expansion. But if you are using it for working capital financing, take for instance, maybe you are into trading, and let's assume it is season, it is Christmas period, so people are demanding more of your product, and you need that money to be able to, maybe you're selling 100,000 units before now, but you need to increase it to 1 million because of season is coming, and you walk to your bank and say, I need to buy more of these goods because I have more orders. That can work because you're using to finance working capital. So as you buy the more product, you sell, you pay off your debt. But you cannot use that to fund long-term expansion strategy of your business. Thank you.